Good morning. Welcome, everyone. I'd like to welcome you to the AGH Wealth Management's 2023 Outlook webinar. We appreciate you taking your time out of your busy day and allowing us the opportunity to share our thoughts and that of our independent broker-dealer, LPL Financial, for the outlook for the year. During the last couple of years, it's really no surprise that we might be striving for more balance. If 2022 was about recognizing imbalances that had been built into the economy starting to address them, we believe really 2023 is going to be about setting ourselves up for what comes next as the economy and the markets find their way back to a steadier ground, even if we continue to go through an adjustment period. My name is Brad Bechtel, and I am president of AGH Wealth Management. Every 6 months, our firm provides our insights and outlooks on the economy and the market for the year ahead. The slides you're going to see today are available to you in a full color booklet, which we'll gladly make available to you upon request. During the presentation today, if you have any questions, please feel free to email us, and we'd be happy to address any of those after the presentation. My partner in today's presentation is Brian Gensch. He's a certified financial planner and senior vice president here at AGH Wealth Management. His focus is on overseeing our firm's personal investment portfolios and strategies, as well as the personal financial planning. At the conclusion of today's presentation, Brian and I will make ourselves available if you have any additional questions. The webinar today is being recorded for your future reference, and it will be placed on our website at www.aghwealth.com. Without further ado, I'll turn the mic over to Brian.
Thank you, Brad, and thank you everybody who are joining in today. Appreciate the time to hear our thoughts and hope we can add some value and insight for you, and would love to connect afterwards if you have any questions, like Brad said. So thanks for being here. 2022 was definitely one for the books. And so as we share these slides today from LPL Research's team, we're also going to bring some of our own perspective, just how we look at how we forge ahead after a year like last year. So first, we just want to touch base on the economy. So a lot of factors play into whether or not globally the economy will grow this next year. Of course, we have the war in Ukraine. We have these massive projects of the central banks around the world trying to curb inflation. And then, of course, there's population concerns that exist, as well as emerging markets having their struggles. So the consensus at LPL Research is the global economy will likely slow from their upper 2% range or so that'll happen from last year to somewhere in the mid 1% range for this year. So, and you know, a lot of that depends on many factors, one of which is, you know, of course, China's growth path, which is a significant piece of global growth. But for just in general, the US and abroad, an important aspect for investors is that the US appears to have fewer headwinds to growth compared with Europe and other developed economies. The divergence between domestic and international economies is most obvious in where everyone's at in their inflation. So if you look at Germany, which has actually had a little bit of a decrease in inflation recently, but if you look at Germany and the UK, France, Japan, you know, they're still experiencing a lot of them accelerating in rates of inflation. Whereas here in the US, we've likely moved past our peak. Every inflation number we're getting now, which we get another one tomorrow, is showing continued deflationary environments in some cases. So the longer inflation is uncontained around the world, the riskier the growth prospects are in those regions, and the increased risks of seeing recessions happen as well. So it looked very muted growth for this year from an economic standpoint. Here in the US, one reason we're currently seeing kind of a healthy debate on the likelihood of recession is for most of 2022, not every metric was flashing warning signs, but recent data is starting to give us more clarity. One of the pieces that we look at consistently is the LEI index, which is the Conference Board's leading economic index, and which over the course of last year has declined steadily, showing that the economy could enter a period of significant and broad-based contraction. The decline is predictable as many sectors such as housing start slowing, and they've been slowing months ago. Since the inception of the index, a decline of this magnitude over a 6-month period, which is what the graph shows, is always foreshadowed a recession in subsequent quarters. So, we think recession risk continues to exist and appears to be probable this year, but the size and the shape of that recession is less clear. If the economy does fall into a recession, the cause will likely be from the consumer sector, which is all of us, retrenching and slowing our spending after years of inflationary pressures, high housing costs, and slow real wage growth. But recessionary environments usually give way to a loose labor market, and we haven't really seen that loose labor market quite yet. So we also need to look at the labor constraints to see the effect that the rate cycle and inflationary pressures are having on our jobs market, which we'll talk about too. The Fed has repeatedly warned investors about the potential for pain from the fight with inflation. That pain is most likely associated with an expected increase in unemployment as the job market cools from a slowing economy. Jerome Powell even came out, last year at the Jackson Hole meeting and talked about how the Fed was willing to see unemployment go up. I think at the time it was about 3.67% unemployment rate, and they mentioned they were willing to see unemployment go up to 4.5%. That being said, we're sitting today at a 3.5% unemployment rate, and so we haven't seen that effect yet. If you look at this is what's called the JOLTS report, the Job Opening and Labor Turnover Report. The pandemic caused the metrics that are make this index to become off balance. The ratio of openings to unemployed, the number of those not in the labor force, and the percent of firms having difficulty finding qualified workers. So investors should watch. This is one of the metrics that need to be watched through this year as the economy leads to a more balanced labor market. Of course, we've seen a lot of news about the labor market softening. Most of the layoffs that we're hearing, by and large, are coming from mega cap large companies, predominantly in the technology sector. That's not an uncommon area where excesses have built from hyper growth that they've seen over the last 6 years or so. And so some of their shaving off of their labor market has been something that we've seen obviously recently with Facebook and Amazon and Salesforce, and the list goes on. That being said, we haven't really seen, if you look at the labor, and we just got another reading today, if you look at the initial jobless claims, who's filing for unemployment, we continually get low numbers, below expectation. So there's a couple things going on there that could be happening. One, these workers who are being laid off could be going and finding other jobs. We still do have a high count of job openings, and so there's a high likelihood that a lot of these workers are getting back into the labor market immediately. There is also a scenario where some of these people getting let go have compensation packages, and those compensation packages will run out over a period of time, maybe this year, and they can't file for unemployment until that happens. So we're not quite sure with these layoffs how much of it's going to actually impact the labor market quite yet, but we do know that there's still ample supply of job openings that are existing in the country today. So as long as we don't see that labor market loosen quickly and deeply, then then the recessionary risk that is currently here starts getting muted a bit. So we've stated many times in the past, we've done a lot of these these webinars. Economic growth in the U.S. has a lot to do with our ability to spend. So consumer spending is a big piece of that. And in consumer spending, housing plays a significant role in consumer spending, and investors should monitor housing markets as a bellwether for the health of the consumer. And that's what we do a lot. We track household or house sales and new sales, used house sales. Sorry, they call them existing home sales. And we look at cars as well, new and used cars. Right now, about 34% of what we spend is roughly on housing. So we've had a significant increase in the housing market from 2020 to 2021. And we've seen a continual decline in that space last year and moving into this year. And so we see some of that as being what will slowly push down the demand for spending. And that's going to be what could help continue to cool inflation overall as the Fed stays on track with their rate cycle. So data shows people selling existing homes as well as new homes have had really significant drops, which we, again, believe will continue through this year, especially given the mortgage rates today. And we talk about mortgage rates a lot with clients, especially in our planning that we do. And we have a lot of clients who remember mortgage rates when they were in the 15, 18% mortgage rate environment. A lot of buyers today don't have that memory, don't have that experience. So the 7%-ish mortgage rates that are out there today because of the Fed rate cycle feels expensive still. And so we do think that is one of the things that will continue to deter home purchasing, which will slow the demand of spending that we have, which is a good thing for inflation. It keeps inflation down. So if we want to turn to look at the stock market, the equity markets, if stocks are going to go higher this year, there's a few key components. A prompt end to the Fed's rate hiking campaign is likely going to be one of those key components, as well as then earnings, and we'll talk about that as well. The timing of the last rate hike of this cycle is still uncertain and won't be clear for a little while, but the view is that the Fed will pause during the first quarter of this year amid an improving inflation outlook, and if we do start seeing that job market loosen. So they meet next week. Next week, the consensus is from the market that they'll raise rates by one rate, which is equivalent to 0.25%. Then they meet in March again, and the expectation is that they would raise one more and then be done. So should that occur, stocks would likely move higher consistent with history. So stocks have tended to produce solid gains after hiking cycles end. And on average, you see in this graph, 10% gain 1 year later. And if we only experience really a mild recession, that could actually amplify how the stock market recovers and reacts to an ending rate cycle. I think the latest statistic is out of the 13 past Fed rate cycles, only 3 times have they managed a soft landing, meaning that we went into a recession the other 10. And there's a continued sign that we either are going to have a mild or potentially a soft landing still this year. If those were the cases that played out, we would expect the market to react even better than what historically it's done over rate hiking cycles. So we do believe there's still going to be volatility in the market, but we also realize that having the rate cycle end with the Fed is a good thing. And then when we look through many economic downturns, recessions, and the geopolitical crises over many decades, the stock market's always had a recovery. Patience with investors who are able to take advantage of those declines usually have been rewarding. So if we look at following down years, out of the last 18 years where there's been a down year, 15 of those years, the next year has been positive, on average 15%. And I would posit that the ones that didn't have a positive year the next year was because of a deep recession that followed. And we're just not seeing the signs of that right now, but that could change, and that could change the outlook, of course, for this year. So our research team at LPL, their base case for the S&P 500 earnings per share this year is $220, similar to where their 2022 is tracking, and about 5% below the consensus estimate as of a few months ago. We're still getting earnings reports coming out now for fourth quarter. So revenue will continue to get boost from inflation. Many blue chip companies during the third quarter earnings season have demonstrated their ability to pass along higher prices due to their pricing power. And we're seeing somewhat similar abilities this year in earnings reports. But profit margins, so the ability for companies to make profits, likely could compress further over the next several quarters before support from those lower costs can arrive. Right now, our profit margins are still significantly high. They are lower than the highest levels that they've been at in this last economic cycle, but we're still really high in profit margins. So there's still a lot of margin there, and that's a good thing for earnings, which is a good thing for investors. And we really think that this year, what's going to be more in focus is the earnings and not the Fed. You know, the Fed last year, the Fed got a bad rap. They got a bad reputation. And if you look back, 20 plus years, and you look at the Fed and how they've communicated with the public in their cycles that they've gone through. You got Greenspan and Bernanke, and really before them, the Fed was a very kind of closed door group. The public would really find out what they did after they did it. And it wasn't really till Janet Yellen came in when we started to get more transparency with the Fed and what they were doing. And you can remember in 2008-9 financial crisis, we were coming off of the worst recession since the Great Depression. And I think, what Janet Yellen's point of view was it's better to err on the side of transparency at this point, because we just instituted these very huge quantitative easing programs that are basically experiments with our economy, spending $4.5 trillion and not really knowing the inflationary effect of that. And so she really brought in a lot of transparency and communication. And when she didn't see inflation, the Fed did not raise rates quickly. And then you fast forward to the end of that rate cycle when Jerome Powell took over and kind of overcorrected and brought us back down in 2019. And right back in, and then went right into the pandemic, and of course we slammed them to the ground. Coming out of that, though, what I would say is the Fed was overly communicative to a fault. And it kind of created this good cop, bad cop feel where they were telling us it's going to be okay, and then data would come in and that would change their mind, and they'd say, well, we got to be tough. And then, the markets would freak out, and they'd say, give it a little time. They'd say, well, hey, we're not going to just raise rates till the end of time, and markets would settle down. And then the data would come back bad again, and they kind of created this wish-washy looking environment. And the reality is we don't know what past Feds have been, how wish-washy or how many times they've changed decisions because the data came in. But because we have really created a transparent Fed, it really caused us to then second guess what they're going to do next, and them second guessing what they were going to do, and then having to change their mind. And that's where a lot of this volatility, I think, also came from, was just the transparency almost to a fault, because we really didn't have the data yet to create a direction. That's if we were to say what were the reasons of the volatility last year, we really would say the Fed and their reactionary environment to inflation was one of the main things. Earnings weren't negative, and so you can't blame it on earnings. We weren't at super. I mean, we had certain sectors in the market that were high priced, but we didn't have a ton of sectors that were just. The whole market wasn't completely overpriced. They were inflated, and they were better than fair, but it wasn't a valuation issue even. It was purely the interest rate increases affecting everyone's view of the economy and the markets going forward. And so I think this year we're not going to see that same kind of a playground. It's not going to be what the Fed does is what reacts to the market. I think the market is turning to real data and turning to fundamentals in the market and earnings And earnings is going to be important this year as much as the Fed was important last year. And the reason I say that is because we've seen a shift in how the market responds to news. For the last 6 months prior to this month, it seemed like every time we had a bad economic data come out, the market was positive. Or if we had positive economic data, the market went negative. And what was happening was the market really didn't like the Fed's rate cycle and the quickness, the acceleration that it had. So any bad news meant that the Fed was getting what they wanted, which was a slowdown in the economy, which means that they would slow down their rate cycle. So you had this very uncharacteristic environment where bad news was good news to the markets and vice versa. That's something that we've seen shift this year, where now we're already starting to see bad news is bad news in the markets and good news is good news in the markets. Today's is seemingly not an exception to that, as we just got great GDP numbers, and we're not plummeting in value in the Dow, the Nasdaq, or the S&P. So I think what's happening is the market is turning back and looking at earnings and saying, can we make money still? And that's going to be one of the most important things to see throughout the rest of this year, is how they handle the ability for inflation to come down and for potentially the job market to get a little looser, and whatever happens with consumer spending. That's going to be the big key. So LPL Research team has a committee. It's really a mouthful, but it's the Strategic and Tactical Asset Allocation Committee. And they come out with these different case scenarios. You can see bad case, base case, and good case scenario, or bull case. So based off their percentage of likelihood or probability, with all the different aspects that could affect or be affected by these different cases, their estimate is that the S&P 500 could end the year between 44 and 4,500. Where are we at right now? We're at about a little over 4,000. So, I think the consensus is from a fair value target, which isn't trying to guess exactly what the S&P is going to be at the end of the year, just saying this would be fair. There could be a 10-12%, value enhancement between now and then, from a pricing standpoint. But you got to look at all these different pieces that affect that fair value: inflation, interest rates, the Fed, earnings, geopolitics. All these things are things that we're too early in the year to be close enough to say, hey, these all will play out exactly how we think in each of these scenarios. That's not the case. So, of course, we don't plan. We're not in the business of being predictors. We don't. We're not fortune tellers. We don't have, magic 8 balls that tell us what's going on. This is the best as we can get with figuring out what the future looks like. And what this says to me and should say to you is there's still some uncertainty out there. Things are pushing in the right direction, but there's still some uncertainty. So, so the base case really is that there's actually more of a case that we're going to be okay than that we're going to run into this hard landing with the economy and run into a deep recession. Another thing before we switch to bonds to talk about, and just because it's just recently happening too, is we're breaking through some pretty important technical resistance levels. And I'm not going to get super nerdy with this, but when you're looking at the markets, you look at fundamental analysis and technical analysis. Fundamental analysis is like, how are the companies doing? How are they making money? How are we pricing that? Technical analysis is what's the trend? Where's the momentum in the market? And if you look at all of last year, the momentum in the market was obviously down. We had these rallies that would come, and we would hit this continual downward sloping resistance line. And it just seemed almost, at the 3 or so times that it hit it, it was just right on point. And there's an indicator that we look at, it's called the 200-day moving average, and that was basically similar to that line. So all that to say, recently we've broken out of that, and that's important from a technical standpoint. So that's a short-term maybe trend shift that's being signaled, and that has nothing to do with is our earnings going to be okay next year, or are we going to go into a recession? but it's a healthy thing to see that short-term trend is shifting. Whether we go back and test our lows in October, not sure. But is it a good sign that earnings isn't cratering while we're getting reports? Inflation is still coming down and technical momentum is shifting. Yeah, those are all things that we look at and go, those are good things to build a base for this year of a positive growth. Okay, so turning to bonds, we see a very different environment running into this year versus last year coming into the year. So the path of interest rates will certainly be largely influenced by the Fed's behavior, which we believe will be guided by economic growth and inflation, like we've said. Equally important is in bonds, as we look at the Treasury yield curve and where that's at, equally important in that level is the level of non-US governments and their bond yields. So one of the things some people don't realize is, foreign investors are an important buyer of US Treasuries. A lot of central banks around the world hold US Treasuries because of the safety of the US Treasury versus other government bonds. Right now, what's happening is all those central banks are also fighting inflation. And one of their metrics they're using, like ours, is interest rates. Well, as they raise interest rates, it becomes less and less favorable for them then to buy our Treasury. And so as they raise rates to fight inflation, and we have higher foreign market yields, all else equal, that would kind of generally persuade foreign investment into our markets. And so there's just a range of scenarios that could play out over the next year. However, given the view that the US economy could eke out a slightly positive economic growth in 2023, which will also affect it, LPL's consensus is then the 10-year Treasury could end the year around 3.5% or so. Right now, if you look at the 10-year Treasury, it's at about 3.5%. So what's that saying is the base case is there's just potentially not much movement we're going to see in the Treasury market in the more longer term, the 10-year Treasury market. And that's what affects bonds, which I'll show you on our next slide, as rates increase or decrease, how that affects different parts of the bond market. So again, there are a range of scenarios that could play out, and a lot will have to do with the Fed's reaction to the data. If they do what they say they're going to do. And the closer we are to the end of their cycle, the more probable and predictable that'll be. And so we feel we're in a much better position with that now than we were, 8-9 months ago when they started this cycle. So as you can see in this slide, LPL's consensus is that there could be a softening of the Fed funds rate by the end of the year if we get this flattish growth or mild recession scenario. Now, the Fed's come out and said they won't lower rates this year. I think what the market's done is kind of shrugged off anything they've said now, because we learned last year that you can't trust it, especially if they're talking about something they're going to not do for 12 months. That's just way too long of a period of time for us to trust that they're going to stick with a call like that. Right now, the market has a slight expectation that after their 2 rate cycles that will go up, their 2 rate hikes this month and next, there is a chance that there could be a slight reduction. Our view at AGH is that the slight reduction would only happen if we dipped into a recessionary environment that seemed more than mild. I don't think the Fed is looking to run back down to 0% interest rate environment anytime soon. So the aspect of the bond market being able to be benefited from by super lowering of interest rates, I don't think that's a scenario that exists this year or even potentially next year. So currently the Fed has a year-end target of just around 5%.
Brian, we might want to address the impending debt ceiling issue that we have, and what effect it either already has had or what it might have on obviously Treasury yields as we go forward.
Sure. Yeah, I mean, it's it's a bit of what we're seeing is a bit of the political gaming that happens. We've had a debt ceiling for 80 years. It was initially came out to have a debt ceiling to fund World War I. More recently, in the last 40 debt ceilings that we've been raised, or 40 years, we've done it 45 times. We've raised the debt ceiling 45 times. 45 out of 45 times, I might add. There was not a period where we chose as a government not to raise the debt ceiling. What is the debt ceiling? Well, the debt ceiling is basically the ability for us to issue debt to a certain point. And when they hit that ceiling, unless Congress approves a higher ceiling, we cannot raise more debt to cover our budget. What's interesting is you kind of figure out what's the cart and what's the horse, or what's the egg and what's the chicken, because when we're talking about the debt ceiling, it's really not talking about, hey, we need to increase our debt because we want to, we've got a new budget coming and we really need to hit it. It's really saying we need to increase our debt to pay for the budget we already approved. And so, without getting into the political, conversation, the ability to decide whether or not we should spend more or less as a government has to happen at the budget meetings, not at the debt ceiling meeting. But what happened and I don't know if this is when it initially became the biggest moment in time where the government realized they could use this as a leveraging tool, but it was really in the Obama administration when it became became a hostage, if you will, and then concessions happened. And so I think what happened was, back in 2008-ish or so, the government, the different parties realized they could use this as a negotiation tool. And so the likelihood of not raising the debt ceiling, defaulting on our debt. The most recent, when we had something, a scare, that was in 2011, and because of that, the S&P, which is a large rating agency, downgraded the U.S. debt. And if anyone remembers that, I do, because it happened while I was at a conference. We had a pretty volatile market then. Now we had come off of a market that wasn't very volatile, unlike today where we have already had a lot of volatility. You would think that if there's a true risk there, that you would see that play out in what currently the Treasury rate is doing. Again, the markets tend to forecast better than most people can forecast things that might happen, including recessions and expansions and whatnot. We're not seeing a huge shift in the Treasury yield curves now, which would say that either this isn't a real risk that's out there, it's just being headlined as a risk. And I know we've seen Janet Yellen say she's going through extraordinary measures. Well, the things that they're doing, they did 2 years ago. So I don't know if you can call it extraordinary measures when you did it 2 years ago. So there's a little bit of political gaming, I think, going on both sides. And what I don't think it's healthy to use this as a tool for that. But the likelihood of any political person wanting to put their name behind a reason why Social Security payments didn't go out or why Treasury bonds didn't come due. And the thing about with Treasuries, we've been buying a lot of short-dated Treasuries to help people with their cash positions. And that is, by the way, not a recommendation to anyone to do that, since this is a general, conversation. But, the aspect of the Treasury market that makes the Treasury Department so much safer is that they print money. So municipals can't print money, corporates can't print money, but the Treasury can. And while that's not a healthy thing for us to do to cover our debts, the likelihood of not being able to pay back our debts is still really, really low. And the reality that this debt ceiling will probably get raised, like it has 80 out of the last 80 times we've had this conversation, is probably pretty high. But it is what's in the news today, that's for sure. So, how do rates affect bond prices and bond markets? The classic way you say it is if rates go up, prices go down, and vice versa. So there's some expectations for these various fixed income markets under different interest rate scenarios. You can see how they would be affected. If interest rates don't change at all, which is the grayed out column, the best expectation for performance over the next year would be really that you just get the yield that those bonds are paying. So, if bonds are paying about 5% right now, and if we don't see a massive shift in yields, then stands to reason that you would make about 5% in that bond market. Last year we saw a huge shift in the bond market to the negative. Worst bond market in the history of the bond market. Broke all kind of records we didn't want to break. Interest rates were the reason and the effect of that bond market, from the increases we saw last year and the acceleration of those, how fast they went up. It roiled the markets in the bond market. As the Fed comes to an end, and with the expectation that the 10-year Treasury really may not move much at all this year, bonds should return back to their safe haven diversifier that they've been known for. And you can even see that, so much so that if we do run into maybe some sort of more recessionary environment and we might see a drop in interest rates at the 10-year level, that would actually be a pretty decent boost to the bond market. So again, we look at the bond market now as being back to that diversification tool that we have used for so many years that broke down last year. So last year, it was the 60-40 portfolio's dead. Well, it went to sleep for sure, but we think it's back and awake, and we think it's active, and that it'll be back to more of a traditional relationship between stocks and bonds this year. Another thing when you look at the credit markets, seeing how high interest rates are is you can make it seem expensive to do business. If you look at businesses, two of the primary large costs in a company are their people, wages, and the cost of their debt, their interest on their debt, which typically is floating for companies, publicly traded companies. So you would look at the interest rate environment from last year to today and say, wow, like this is going to be a major hit on earnings. However, as this graph shows, companies were actually able to refinance existing debts over the last few years and push out their maturities. So back in 2020, when the pandemic hit and we slammed rates to the ground, and really in 2021, we had no rate increases at all, money was still cheap. Well, what happened was a lot of companies came out, and the debts that were maturing soon, they went ahead and refinanced. And so as a result, only about 1% of all existing debt will be refinanced this year. And if you look at between this and next year, only 10% combined will be refinanced before 2025. So the need for companies to have to refinance existing debt at these new higher rates is currently muted. And so the high interest rates that we currently see actually won't potentially dampen the profit margins as much as other things could dampen it, or as much as it has in past rate hiking cycles. Just to talk a little bit on geopolitics. Of course, the geopolitical environment has a lot of uncertainty in it. We've got the Russia-Ukrainian war, the conflict there, and all the diplomatic attempts for negotiating settlements. And of course, we're hearing all the different involvements now that are happening on either side with, NATO countries, and then, potentially with China and their, support potentially with Russia. Then you've got the China-Taiwan conflict that just is still there, and Japan, even with North Korea, there's some conflict there as Japan increased their budget 25% of their GDP to go to defense spending. So geopolitics are going to play a piece in, they always play a piece in kind of the stability of the overall global markets. One of the things that we can see from the kind of that geopolitical what happens in the effect, the cause and effect factor is what happens with commodities. The commodity super cycle that was spurred on by China's hyper growth rates in the beginning of the century have really waned significantly. China's leadership has obviously turned and focused heavily on COVID-19, kind of the at all cost mode, the zero COVID policy that has now been, dialed back, and travel has begun to ensue again. So some of that stuff's coming out, but that really took a hit on their economy and stagnation that they'll have. Of course, then there's a boom in real estate projects, and those have slowed dramatically as developers have mired in debt, and expect commodity prices to continue to react to global supply demand pressures. The U.S. dollar is coming off of historic highs, and that could help buoy the overall commodities market. But all that being said, we really are more focused on the discounted prices that are happening in the stock market and the bond market over the commodities. Commodities were really one of the diversifiers last year, not to the extent that we would want like gold to be a diversifier in the environment of like last year, because it didn't show up. But in general, commodities have really felt to be kind of some of that diversification factor, but especially running into potential recessions across the globe, there's going to be a bit of a strain on that. And so we really stay more focused on the stock and traditional bond markets than on the commodity side. So from a policy standpoint, of course, 2022, we had midterm elections and was maybe closer than expected. But in the end, I think voters chose to rebalance the power dynamic in Washington. And it was somewhat expected that Republicans could gain the House, although they only gained it with a narrow majority. I think more narrow than maybe the pollings had said. And Democrats held on to the slim majority that they had in the Senate. I think they increased one seat. So despite the narrow margin now that the House has with the Republicans, that victory does significantly shift the balance of power, since only legislation really now with bipartisan support will be the legislation that can get passed once the new Congress is sworn into office. Well, I guess they're already sworn into office now. So this year. So what does that have? How does that affect the markets? Well, maybe the most important thing about the midterms is that they're over and they're behind us. If you look historically, midterm years have been volatile markets. 2022 was just another one of those, and not an exception. But the third year of the presidential cycle, which is what we're in, has actually historically been strong. Has been strong, and the weakness in 2022, being so much graver than even your averages, kind of helps set up that pattern again. Now, the one thing we're not going to have this year that you typically have in the third year presidential cycle is fiscal stimulus. Typically, there's an increase in fiscal stimulus, kind of anticipating the presidential election, and think about that with what you may have, why that happens, but it typically does happen. That is probably not going to happen this year, given where inflation's at and the whole goal to take away stimulus that's stimulating the economy, which in effect was stimulating inflation. Having that balance of power is most likely going to stop any sort of fiscal stimulus on either side to make its way through. So we won't get that tailwind, but we do have the tailwind of all the other things that we've already talked about. Additionally, and you have to take all these with somewhat grains of salt, economic cycles don't follow presidential cycles. So let me just say it that way first. But there are some significant mixes of government, if you will, that markets have looked like had seemingly better performing years. This is not the conversation we have to talk about why, but this is just to show that that's typically happened. And if you look at having a Democratic president and a split government, that's been one of the stronger performing markets as well. And so, again, not saying that this is the end all be all, but we believe that a lot of times when you have the ones that are showing higher averages of returns, typically are ones that are showing a split in government, whether it's from the Congress to the Oval Office or an actual split in the House and the Senate. So having that kind of split, if anything, only adds credence to the fact that the other things that are happening may not be thwarted by noise in Washington because of one side or the other having full control. We've talked about that for years, over multiple presidential cycles. We've had that kind of conversation. We're just in that year that could potentially play out. So we covered a lot. Stocks, bonds, economy, politics. All in all, though, we do believe that this year really is a return to balance, and that will be in effect. The shift from watching the Fed to watching company earnings is a healthy shift. This year, we expect bonds to shift from doing what stocks did to being bonds again. Stocks to maintain their footing. We expect the Fed to become less noisy. The main thing that always we want to impress to an investor is looking at your personal plan, right? Sticking to your long-term strategy or short-term strategy, depending on where you're at. But sticking to that strategy and making sure that the way you are investing for those time horizons and those risk tolerance is much more important than trying to guess the month-to-month shifts that happen in the economic data that comes in, the technical markets that trade, and the political, swinging effects that happen with the noisiness there. Sticking to a long-term strategy of your own strategies can sometimes be the most important piece, especially for a long-term investment horizon. And we also remind a lot of our clients, that long-term for a retiree, sometimes if you're in that mode, doesn't feel long-term, but if you're a retiree, some of the money that you have may not be used ever, may be used in 20 years still. So some of your asset allocation still has potential long-term time horizons. Sticking to investment, allocations that make sense for your time horizon is more important than listening to 50 of these different webinars and trying to figure out, which sector to throw all your money in. The market tends to always surprise us to the negative on that being a bad decision. That being said, as a side note, with all this, our research team at LPL, who I think is a fantastic team, I'm on a morning call with them every morning, but the markets are open, a wealth of knowledge, and they're increasing their footprint of who's in their team yearly. They do have monthly information that they can send us that just talk about different asset classes and sectors, and what are more favorable, or what they have a neutral stance or a negative or positive stance on. If you're interested in knowing more the detail of that and how that could affect your personal portfolio, and you don't already work with us where we're already doing that, happy to reach out to us. We're always happy to share kind of where we feel we're at in the markets, and also where our research team at LPL feels like they're at too. So with that, Brad, I'll kind of let you have any closing thoughts or comments, and then we can let these people go back to their day.
All right. Thank you very much, Brian. Nice job today. Thank you all again for attending this today. Hopefully you all found pieces of this that you found were helpful, and maybe answered some of the questions that you had. Obviously, the market continues to move forward, and as I was talking to a client the other day, where it was yesterday or 2 weeks ago is not where it's at today, and it always makes it challenging to keep up with the new direction. Just as a reminder, the webinar was recorded today and will be placed on our website at www.aghwealth.com. As Brian said also, and I just want to mirror it, we do have monthly market updates that go out from our website, and if you're not receiving that and you would like to get that, please reach out to either Brian or I, and we can be sure you get set up for those and get signed up. Otherwise, thank you all very much, and if you do have any questions, please just reach out to one of us and we will be happy to respond. Booklets are also available, so if you'd like a copy of those, please let us know. Thank you all very much, and have a great day.
Yeah, thank you, and we look forward to talking to all of you, or at least talking about markets at our mid-year, which will be later this year.